Hello, everyone. Welcome to another episode of Simply Finance. I am Shane White, your host. Today is episode 23, Thursday, April 16th, and it's in the evening for this one. And today was a slightly green up day for the market. S&P was up 0.58%. The NASDAQ had a big day, 1.66%, and the Dow was up 0.14%. The day started off red. It looked like there was going to be a bad day for the market, but I think with a lot of this new coronavirus news, people had some optimism towards the end of the day, and things kind of turned around. So another green day, nothing crazy for the market, but it is interesting to see these trends. Tonight is the big announcement from Donald Trump on what the next phase of getting the United States economy back online will look like. So, depending on what he says tonight, tomorrow could be a very interesting day for the markets. So, tomorrow that'd be a good thing to talk about. As far as today, so today the concept of the day is market capitalization, or market cap is kind of the slang term that you'll hear a lot in the investment community. And what that really is the value of the company. So in the stock that they have listed and what you're investing in, this is the true value of the company. And it's a great tool to really measure the size of the company, number one, as well as how you can kind of compare the size of a company to other companies in the industry that they play in, etc. And it really is a very simple math formula, right? So all it is the number of outstanding shares times the current share price. So if you bought a stock for $1 and they had 10 shares outstanding, obviously a very simple equation, 1 times 10, the company would be worth $10. So that's all it is. That's literally what it means. But it's a one way. So that way, depending on the number of shares, that is also what helps drive the price, right? A lot of people that are looking at the price, they're looking at market cap as well as a lot of their financial statements to really understand if this is a good investment or not. So that's what market cap or market capitalization is. It's just their value. Think of it as like their market value. So when you think about market capitalization, there's 3 buckets you can fall into. And really there's more than 3, but there's 3 main ones. Number 1 is large cap, and that is when the value of a company is greater than $10 billion. A good example of this is Apple. Apple's is worth over $1 trillion, which is crazy. And that first happened a little over a year and a half ago now. They were the first company to break $1 trillion. So what this means is generally, the company's not going to have, in general, right? It's not going to have huge returns over a short period. So it's not a stock that's going to like blow up. It's usually a company that's been around for a while. It's a leader in their industry. But what they can bring is long-term gain. So someone who wants to invest now and sit on it for a long time, a large cap stock can be great for you, as well as usually a lot of them pay dividends, and then a lot of them will increase dividends over time. So it's great for the long-term investor, and it's a good way to hedge by adding large cap stocks to your portfolio. The next one is medium. So a medium or mid cap, as people call it, would be 2 billion to 10 billion in value, that range. A good example of this is something like Dunkin' Donuts, right? They're an established company, but they operate in an industry that is experiencing growth, right? So that the industry they play in general is growing. They are a large competitor in their industry, and they can experience large growth as well. They have the potential to. If their industry is growing and they're already a mid cap, the chances are, if they do things right, they could see massive growth. So for a mid cap stock, you're going to see higher risk than you would in a large cap stock, but you also have a higher chance for growth, if that makes sense. And so the last one would be a small cap. Now, a small cap is anywhere from 300 million to 2 billion. And I decided, for an example, to use GoPro, as I talked about in my last episode, as my worst investment I've ever made. So GoPro is usually either like a young company or in a niche market for a specific service that's not like an enormous industry, or it could just be a new industry too, that some companies will fall into it for that. It really, in general, if you think of all three tiers, the small cap stocks are going to be those companies that are higher in risk, right? And that they're really higher in risk due to just the general um, age of the company, number one. A lot of times the markets they serve are going to be a lot more risky. There's a lot more volatility in these smaller cap stocks, and their overall size, right? And really, like smaller companies that fall into the small cap stock, they have fewer resources, and most likely they're going to be a lot more susceptible to things like economic slowdowns and the coronavirus. So this is a good example of an area where you may not want to be in as a company or an investor when things like this happen. But it could be great when you come out of the recession, right? And then just a few misconceptions. So the one misconception is that this is the only value that the market is willing to pay for. This is the only value that the market is willing to pay for its shares. That's not entirely true. Like this is the value that your share of the shares, right? So this is the value that the shares in the market are, but there's other ways to calculate value of a company, especially if you're going to go into a merger or acquisition. If you're public, this is not what you would use to value the company. You would use something called the enterprise value, which looks more in those financial statements and looks at future cash flows. And I'll go into that in a future episode. So that's one misconception. That's not what market cap is. That's kind of a gray area that most people maybe don't fully understand, but it does not necessarily mean if you sold the company today, you would get what the market cap is. That's not what that means. And really, again, like I said, this is the cost of buying all of the shares of a company. So for Apple being $1 trillion in value, that just means that if you bought every single share of Apple, it would cost you $1 trillion today. And that's if you're just an investor. That doesn't mean the same thing if you're a public or private company that wants to acquire someone. So enterprise value would be a great one to dive into with you guys in the future, because that's a lot more detailed, and that's what's happening when companies buy another company, for example, or merge together. They're looking at enterprise value, and they surely factor in market cap. That's part of the equation, but that's not what drives it. So that's all for today. Very simple, quick episode. Market cap is talked about a lot in the investment community, a lot in the news. So I want to make sure you guys knew what that was and can use it to, again, help diversify your portfolio. It's great to have a few large, mid, and small cap stocks. It's just another way to help diversify. So thanks again for listening today. Tomorrow should be an interesting episode, depending on what the news from Trump's speech tonight is. So I will see you all tomorrow. Have a great evening. Stay safe, and I will talk to you soon.